Welcome, investors. What will 2024 bring? We have the battle for presidency between President Joe Biden and former President Donald J. Trump. What is the likelihood of a recession in 2024, and what has the stock market, the commodity market, real estate, cryptocurrencies, and the bond market done during times like this? We're going to take a look through the lens of history to find out. But before we do, if you find value from this video, be sure to like the video, subscribe to our channel. I'm your investment advisor, Representative Jake Ackerman. Let's dive into it. Okay, so we all know the likely probability is very high for the showdown for presidency between President Joe Biden, former President Donald J. Trump. It's highly, highly likely. There could be a few wrenches thrown into it. We all know during election years that crazy, wild things happen. Expect mud to be thrown, not a lot to get done by Congress, the Senate, the presidency. They're going to be focused on the election at hand and ignoring everything else that's going on around them, such as the economy. So that's what we are here and we need to be aware of, because there's going to be lots of distractions, a lot of political battles, headlines, yada, yada, fighting. Great times. Division, expect lots of division between the left and the right, and everyone else in between just very confused on what's even going on. So let's move into some history. I was doing a little bit of research between the 2008, 2009 area, maybe even a little bit of research into 2007 were there any clues, were there any breadcrumbs that could have forewarned us of the great financial crisis of 2008, 2009? And during this research period, I found that there was lots of little breadcrumbs. People talking about a possible recession with many different data points. But there was also headlines of this time is different, we have a great economy, unemployment is very low. So we need to be able to determine if a recession is likely to take place in 2024. We can't just look at one data point. So they're saying unemployment's very low, gross domestic product is positive for the quarter. We can't look at just one thing. We need to look at many things during previous recession timeframes, and that's going to give us whether the 2024 is a likely recession year, or are we likely just in a soft landing, going to avoid the recession altogether. So I'm going to start laying out the case for the high likelihood of a recession in 2024. Let's start with this. This is a chart that I brought to your guys' attention several times throughout this year. It's the inverted yield curve. So the magenta areas that are vertical are the recessionary periods. Up at the top is the 2- and 10-year Treasury spread. That line through the middle, that zero line, is when the yields go below that zero line, they're officially inverted. Okay, what do I mean by an inverted yield curve? Very simply, the shorter debt instruments, so like the 2-year, yield higher than longer term, like the 10-year, the 30-year. And that doesn't make much sense. That shows the economy is sick. If you're tying up your money for a longer period of time, you should earn a higher interest payment. And when the economy's sick, that flips. The shorter time frame has a higher coupon. So we can see through history of these recessionary periods, the yield curve inverts, showing the economy is sick, followed by a recession. Well, we got one March 2022. Let's move on to this fantastic research done by Steno Research. It's going to touch on GDI, GDP, and we can see they're very correlated when we're going to take a look at this chart down here, yet can vary. So the GDI is in the blue, GDP is in that black. Again, they're correlated down to that dot-com bubble, slightly negative. GDI led in the 2008-2009, down, followed by GDP. Here in 2020, everything went down. And again here, now we have GDI negative, GDP still positive. This is a little bit longer time frame showing basically the same exact deal. Recession, cross down, but negative. 1990 went negative. 2000, they both went negative. 2006, 2007, same deal. And again here, GDI is negative. Will GDP follow? Here's a breakdown of what GDP is made of. So you have in that orange is the average, that's the real GDP line. Government consumption is green, domestic investment, blue, private consumption, net export, black. Okay, GDP went negative, 2008, 2009, 20. Where we are right now? GDP is up, but we look at what's holding up. Government consumption, private consumption. People are putting money on credit cards, government spending like crazy. U.S. imports they rarely drop except during recession time periods. Not always, but during recessions. Again, that's that shaded color in the background. Recession, negative, recession, negative, recession, negative, 2020, same deal. And again, we're negative. Will we get a recession? GDI, this is what GDI is made of. Again, that orange is the average interest income, subsidies, profits, taxes, wages. So you see that's what that's made of there. Again, recessionary time frames, GDI goes negative and being held up right now by wages. Corporate profits rarely decrease year over year, except during recessions. But again, that's not always the case, but high percentage of the time. That one missed. Recession, 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 and here we are, we're negative again. But I get this all the time. Jake, we haven't seen a recession yet. The Fed started raising interest rates March 2022. Unemployment's still low. We're not going to get it. Profits are still hanging in there, even though they're coming down. And same with job, and actually unemployment is starting to tick up. We got to remember this. These things take time to develop. So we experienced an inverted yield curve March 2022. It was very slight. There's actually a discrepancy. It could be either March 2022 or June 2022. Somewhere one of those two areas did experience the inverted yield curve. So where are we today? What would be 2 years? 24 months, either March or it's going to be June. That's the 24 months to 2 years since the inverted yield curve took place. Let's see what history can tell us. So this chart here is the number of months between the yield curve inversion and the start of a recession since 1978 to 2022. 1978, that took 17 months. 1990, 10 months. 89, 18, 20, 2000, 13, 2006, 22 months. So 22 months right now would be January or possibly May. However, we've experienced something quite different than any of those previous times. We had a huge explosion in the money supply, like 40% of the money supply in 1 year. So this is going to take longer for us to feel the full ramifications. We need to be patient and understand that these things are still developing when we are seeing the numbers start to slow down. All right, let's shift gears into what has the stock market done in history and during recessionary time frame. So I have this research done by Fidelity. The worst is over for stocks before the rest of the economy. In almost every case, the S&P 500 is bottomed 4 months before the end of a recession. The index typically hits a high 7 months before the start of a recession. During the last 4 recessions since 1990, the S&P 500 has declined an average of 8.8%. In over half of the 13 years with recession since World War II, however, the S&P 500 has posted positive returns. I know I'm going to explain that here shortly, but I need to go one more point here. Steep peak to trough. Since 2000, the S&P 500 has fell an average of 38.61, the highest during the recession, while the NASDAQ fell 41.17. Okay, so the stock market is preemptive. It's going to react and do things before a recession takes place, before a slowdown happens. So the majority of the damage is done in the stock market before a recession takes place, roughly 7 months on average. And it's the stock market will start to recover during the recession. That's why we don't see, the average decline is 8.8% during a recession, because it's already recovering 4 months before the recession concludes. So prior to the recession, stock market really gets beat up, battered. During the recession, before the recession is over, it will recover. Let's take a look at what gold has done through history. And gold is going to be correlated to other commodities. They're all move fairly in tandem, a little bit of difference. Gold, silver, uranium, palladium, your crude oil, your natural gas, again, a little bit different. Crude oil, natural gas have politics and OPEC at play. So that's a little bit different, but they're all similar. So let's take a look at gold. So this is a long-term gold chart I have up here for you. We'll start with 1980s. It shot up before the 80s because of massive inflation and then big interest rates, and it fell. 1990, recession, down a little bit. 2000, down a little bit, but it started to rally into 07, 08. It was lots of inflation and then was cut because we had a deflationary cycle, so it actually dropped in 07, 09, or 08, 09, and then really started to take off. And then 2020, we had a disinflation, but we had supply chain issues making commodity prices go up. And then now we're up quite high now as far as like historical gold prices. Do we have supply chain issues right now which cause gold prices to go up? No, we don't. Do we have a likelihood disinflation or disinflationary pressures next year? Absolutely. So gold is likely, and these commodities, probably to go down. However, geopolitics, China invading Taiwan, Iran conflict with Israel, Russia, Ukraine, if those things intensify, we could easily see commodity prices start to tick back up. I want to touch on cryptocurrencies real fast. I don't have any good charts for you because cryptocurrency futures are relatively new, altcoins are relatively new. However, cryptocurrencies have not been acting like a flight to safety, has not been a protective play since it's really been incepted. It's been more of a speculative play, a risky play. So as we go into a slowdown, money flows into safety. Cryptocurrencies aren't necessarily the safety play as of yet. Doesn't mean that doesn't happen next year if we do go into a recession. It could change. It could be the flight to safety. I don't think that's the case. I think more likely that we see a run from speculation. But what could happen is, in order to stop the recession, the government prints a lot of money, weakens the dollar, and then we see this big inflow into cryptocurrencies as a hedge against the declining dollar. That's, I think, more of a probability at that point. Okay, let's shift gears into real estate. So I have a historical real estate price chart of the value of U.S. real estate and the cost to rent. Let's take a quick look here, compare it to the recessions. Again, in the background, the shaded areas are recessions. So we have the 70s. Coming out of a recession, prices start to increase into the 80s, into the recessions. Real estate and rental prices take a big decline. The 90s recession, again, we've seen real estate prices and rental prices come down. And then the real estate and rental prices ignored the 2000 dot-com explosion, and then 2007, 2008, we all know what happened there. And here we are again today with prices really ticking up. Basically, I mean, they're historically, I was looking at National Realtors Association. They may not be the best forecasters because they have immense bias. I mean, they have to be on the side of real estate. However, they do release good data points that we can try to interpret ourselves. That 80% of U.S. real estate is overpriced. Is that the best place to park our money? Likely not. Just like the stock market, gold maybe more. That seemed to be holds up better during a recession. Real estate at this point, there's low inventory right now, but people have second, third houses. They may be forced to sell, forced liquidation when we hit the recession because people lose their jobs and they're no longer can afford these high prices. So that would be where our inventory can potentially come from. And home builders are still building. They still have a lot of inventory that's going to come to the market. So could you have 1-2 punches at this point and you still have high interest rates? But however, right now, people are feeling what's called FOMO. And since the interest rates have come down some, but we know that we need to be patient. Let's move on to the final market that we're going to discuss today, which is the bond market. So I have up here is actually the Fed funds rate, which is tied to interest rates. However, the Fed funds rate, which is interest rates, are the exact opposite of bonds. So if interest rates are going up, bonds are going down. If interest rates are going down, bonds are going up. So we start here in the 1950s, going into the 60s, recession, interest rate cut, interest rates go down, bond prices can go up. 70s, cut into the mid-70s, recession. 80s, we get a big cut, recession. 90s, cut into a recession. 2000, cut into a recession. 2008, 2009, cut into recession. 2000. And then here we are with highly elevated Fed funds rate with a likely cut into 2024. So as you can see there, opposite of interest rates, there probably lies your opportunity. So stay with us and we will keep you informed and keep you on the preemptive side of these markets. Expertise you deserve, experience you can count on.